Welcome, everybody, to this week's edition of Reverse Mortgage Weekly, where we go over the reverse mortgage program, answer all of your questions. And really, the purpose of this is just to educate as many people as possible about this wonderful program that's changing people's lives really on a daily basis. So, what I had discovered in my industry is that there's a lot of information out there about the reverse mortgage that isn't great information. And I've always told, and I still stand by this. I tell all my clients, if you really want to know the opinion and know how a reverse mortgage works and if it's going to work out for you, ask someone who has one. I still stand by that. It's a wonderful program. There's a lot of different information out there about that, but ask someone who has a reverse mortgage and ask them how it's working out for them. Well, that's my introductory there. My name is Zach Smith. I own Chariot Financial. I've been in the mortgage and real estate industry for 20 years. Let's get right into the presentation here. Let me go ahead and share my screen. So, this is the reverse mortgage program that we're going to go over today. So who am I? Again, I'm a mortgage guy. I've been doing it for 20 years. I'm passionate about helping people finance properties, and we do specialize in reverse mortgages. And gosh, I get on my soapbox a lot with my first-time home buyers and with people who are not owners right now for a couple reasons. One, if you're renting, you're still paying a mortgage. You're just not paying your mortgage. And the thing is that I have found that by investing in real estate early, a lot of people are frankly getting bailed out because of this type of program, because they have equity in their home that they've accumulated over years. There is trillions of dollars of equity in people's homes right now that they can tap into to help them out in retirement. If you rent your whole life and you don't put any funds into investing in yourself and investing into property, it's really a dire situation for a lot of folks. If you're renting, you don't have any equity, you've basically paid someone's mortgage off your whole life. And so that's why from start to finish, I have seen so many people discover victory in their financial situation just because they purchased property. So that's my little soapbox speech today, but it's very important. It's a really sad situation to see someone who's renting, living on a fixed income, who doesn't have enough to make ends meet on a monthly basis. It's a dire situation for some people, and this message needs to be heard. So that's my little sermon for the morning here. So what are we going to go over in this presentation? So we're going to go over who are typical clients that we see for the reverse mortgage. We're going to see what the reverse mortgage is, what the reverse mortgage is not, why people are choosing the reverse mortgage, and how do they work in simple terms. So who are typical clients that we see? Of course, we will work with all walks of life. We see all types of folks who are looking for a reverse mortgage, but typically these are the folks that we see. We see older adults that are looking to increase their cash flow. One of the things that happens in retirement is that our cash flow becomes limited. Because we're just not willing to work or want to work as much as we have in the past. And, for instance, me, I'll probably work forever. They say people like me, they don't, we don't retire. We just fade away. And so that's one thing that I'll probably do. But then again, I may not want to. Maybe when I turn 60 or 70, I'll say, to heck with this. I just want to retire and sit on the beach the rest of the day. So if that comes to pass, then that's typically what happens. So what that means is if we haven't planned, or if we don't have funds in the bank, or if we haven't got access to pensions or IRAs or things like that we've invested in over the years, cash flow becomes very limited. Number two, older adults that need relief from monthly payments. That's like a mortgage loan, car payments, medical bills, credit card. And I mean, the credit card bills are just incredibly high right now. There's kind of like a quiet storm out there of credit card debt. We've got like people paying 30% on these credit cards. In fact, that's why a lot of the big banks are looking to get out of the mortgage business. Well, they're making, 6, 7, 8% on a mortgage interest. I mean, it's a large loan amount and everything, but there's a lot of costs that come with that. They got to service the loan. It's a physical property, all kinds of host of things that come along with that. Well, credit card is just attached to a person, and you're making 30% interest on that. So, right now the banks are thinking, well, hey, maybe we got to switch to more, revolving debt than, do more mortgages. So, but there's a lot of credit card debt out there, and people are getting swallowed up by it. So the third person that we usually look that will come to us for a reverse mortgage are the folks who own their home free and clear. They got a lot of money in the bank, and they'll open up a reverse mortgage for the line of credit. The line of credit is extremely flexible. It really acts as a financial safety net for a lot of folks. Basically, it's there if you need it, but if you don't need it, then you don't have to take funds out of it. So it's very flexible, and people like that sense of security in regards to their financial situation, in regards to getting something like that put together. So this is what a reverse mortgage is. It is a mortgage loan. So it's a mortgage loan. It does have monthly payments. This is something that, I think a lot of people just do not talk about enough about the reverse mortgage, is that there are monthly payments with the reverse mortgage. However, they are optional. So, there's this sentiment out there with a lot of the financial gurus that if you take a reverse mortgage out, oh, you're going to go upside down on your property. Is it possible to go upside down? Yes. But I think the key point with that conversation is that to go upside down on the reverse mortgage, it's really a choice. The reverse mortgage, if you want to make a monthly payment, if you want to pay the balance down, you can. You can treat it just like a normal mortgage if you wanted to. Now, 99% of my clients choose not to. Why do they choose not to? Well, let's take a look at the state of affairs with mortgage financing. So, number one, if you take out a 30-year fixed loan, which everybody takes out, everybody's all excited. I got a 3%, I got a 2%. All the rates were in a situation where you get a really low rate. But the problem is, even though you got a low rate, it doesn't mean you have a lower cost. A 30-year fixed loan is really stacked against the consumer. And this is why. Because on an amortization schedule, especially a long one like 30 years, basically what you're doing is you're paying 50% of the interest on that loan in the first 10 years. What does that mean? So when you make your first payment within that first year, the first 5 years, most of your payment, and I mean a big portion of this, for instance, on a $600,000 loan at 6.125%, your payment would be $3,600 principal and interest. Well, $3,600 you're paying to the bank each month. You're going to work, you're doing your thing, you're making money, and you're taking that money. Oh, here you go, bank. Here you go, bank, every single month. Well, the bank is taking that money and they're saying, oh, okay, 600 of this, we'll take 600 out of this $3,600 payment. We'll go ahead and pay off the debt that you owe us. This other 3,000, we're just going to go ahead and keep that. We're going to take that in interest. And this is how that works, compounding interest in reverse. And an amortization schedule is always going to be stacked against the consumer. But you know what? There's not a whole lot that consumers can do about that, aside from looking at some of the simple interest loans and things like that. And those are some great programs that we offer as well. But so a lot of my clients are saying, you know what? Why am I taking my retirement and giving it right to the bank? I think I'll take that money I was going to make that monthly payment with. I think I'll just put that right in my pocket. Well, the good thing about that is that now you can direct it. Now you have control over that. And we'll go over a little bit more of that in detail in regards to how equity works. So generally, the reverse mortgage has a line of credit cash payout or a tenured payment attached to it. So, what does that mean? If there's enough room after paying off your first lien, or if you own the home free and clear, we can set up the loan so that you have a line of credit that you can draw on when you need it. A tenured payment where you basically convert your home into like an annuity and then it pays you back each month. Or you can get a tenured payment, or no, that's a tenured payment, or you get a cash payment at closing. So a guy in a black suit has a big suitcase full of cash that is handcuffed to his wrist there. He just presents it to you at closing. I'm just kidding. That doesn't happen. But I love painting that picture just because I think it's amusing. So that's what a reverse mortgage is. It's a normal mortgage. It has monthly payments. And it's just like any other lien. The only difference is how you pay it back. And that's how the bank gets paid back as well. All of those payments, all of those monthly payments that you normally be making on your mortgage each month that are dipping into all of your income, uh, having you withdraw from your savings so that you can make that monthly payment, that is all being paid back when you vacate the residence, whether you pass or if you go into a facility, or let's say you say to heck with this and you move to Costa Rica and it's no longer your primary residence. Well, in that case, you would be in violation of your agreement, and they would ask that within 6 months you pay the loan off. So, what a reverse mortgage is not. So, it's not a government takeover of your home. A lot of people like to depict this program. There's a lot of folks out there who are giving financial advice, and some of them are giving some great financial advice, but some of them just aren't painting the whole picture. It's not a government takeover of your home. Yes, it is a government program. Most of them are government programs. There are some conventional programs that are available, but with the increase in interest rate, a lot of those have dried up. But if you're in a condo complex that's not FHA approved or something like that, we can always look at those type of conventional programs. But we only will use it in that instance because the terms are not very good on those programs. The terms on the government-sponsored HECM FHA loans, those are going to be the best terms. So we usually will offer those. It's not a way to make you upside down on your home. Excuse me. You can go upside down on a reverse mortgage, but it is not something that happens overnight. It happens over a long period of time. Now, for instance, myself, God willing, I make it to 62 and I'm eligible for a reverse mortgage. I am running down to the bank to get one. And that's just part of my plan. And, if God graces me with, long life and I live to 100 or, whatever, I would have been in that mortgage for, 38 years. Well, at that time, there's a possibility that I could be upside down on my property. Well, because the reverse mortgage is a non-recourse loan, and there's a lot of language in the paperwork that specifically states that you cannot owe more on the property than what it's worth. So, so if you owe more on the property than it's worth, then you're not going to be on the hook for that deficiency. Well, and you look at that, you're upside down, you got a reverse mortgage when you were 62 and now you're upside down in your house. Yeah, I am, but I didn't pay a mortgage for 38 years either. So what if my mortgage payment was $2,000 and I decided, instead of putting this into giving this right over to the bank in interest, which most of it would be going into anyways, instead of paying the bank $2,000 a month, what if I reinvested that money into a fund for my kid or a fund for my retirement? What would happen over 38 years if I reinvested those funds at $2,000 a month? I'm sure there's some vehicles out there that I could get some pretty good growth, especially right now with interest rates being high. So, and it's not a payment-free mortgage. There's a group got in trouble, Federal Trade Commission, they had their celebrity endorsements out there saying, oh, we're going to eliminate your mortgage. No, we're not going to eliminate your mortgage payment. It's a little bit misleading. Now, do you have the choice not to make a mortgage payment ever again for the rest of your life if you choose to? Yeah, you do. And again, I think my assertion is that if you're over 62, you shouldn't be making a mortgage payment any longer. Because if you are, you're taking it from your income, which can sometimes be fixed, or you're taking it from your life savings, your nest egg. And that becomes vitally important in retirement. And we'll go over this in a little more detail in the next slides here. So, why are people choosing this financing option in retirement? Why is this something that is wildly popular with people right now? Well, let's dig into it here a little bit. In my opinion, whoa, okay. Yeah, I got one of those Apple mouses, real sensitive, so I can go back and forth and got to hit it just right. So it's quite simple, in my opinion. Liquidity is the number one reason these programs even exist. It's the number one reason why I'm out there promoting these programs, because liquidity becomes a huge issue in retirement. The second issue is long-term financial planning. This is the part that a lot of people don't focus on with the reverse mortgage. A lot of people look at this program as a program of last resort. It is not a program of last resort. This is a program that will help you leverage your real estate for victory in retirement. And again, I'm very passionate about this because you see the ladder. You see folks who haven't planned. You see folks who are in a situation where it's, what do you do to help? How can you, see someone, hardly able to afford their rent and just running out of money and the life savings, or, someone at the, and people can work as long as they want, but we do see folks who are in their 70s and sometimes even their 80s, at the grocery store, bagging groceries or working, entry-level jobs because they need a way to keep food on the table. They need a way to make it. There's other ways to solve these problems that we have, and real estate is one of the best ways to do it. So long-term financial planning is really one of the best things about this program that a lot of people don't talk about. So home equity and liquidity. Equity is great, but unfortunately, it is not liquid. It's a lot like having a big glass coffee table full of cash right there in the middle of your living room that you can't get to. So you're on the couch, watching your favorite show and kick your feet up on the table there, and there's just full of cash. And you're just thinking to yourself, this is nice. I got a lot of cash. Well, what if the car breaks down or something and you need that cash? You're trying to get your chisel out, trying to, break into the into the coffee table there to find that cash. Or to get access to that cash, but you can't do it. It's not like we can take a picture of our home and go to the grocery store and hand it over to the cashier and say, hey, I'd like to pay my groceries with my house equity. Doesn't work that way. Equity is great to have, but it's not liquid. And that's the thing. I have a lot of conversations. A lot of people want to buy a home cash, and a lot of people, I don't want a mortgage payment, I'm buying it cash. Honestly, that's not a bad idea. I mean, you could do that. I would never do it, but it's not a bad idea. You can buy a house cash. You don't have to pay any interest. You're paid it off and all that stuff. But the thing about that, though, if you have to prepare for, though, if you put that cash down, is, let's say you owe a property, you find a property for $400,000, you buy it cash for $400,000. Put the 400, say you sell your old home, you use the proceeds from your sale to put down cash, 400,000 on a new home. So you don't have a mortgage, but all that $400,000, you just handed that over to someone else. You lost all control over it, because now it's in the hands of either a buyer, because if you want that $400,000 back out, you got to find yourself a buyer. And then the buyer buy the house and then you cash out. But then where do you go if you have to sell the property? Rents are extremely high right now. Or you put it in the hands of a bank. If you need that cash back out, you're going to have to call someone like myself, a mortgage lender, and get the cash back out for that particular amount. So that's why, in my opinion, using leveraging, and I'm a little biased, I'm the guy you go to to get money for homes. And here I'm telling you, it's a good idea to get money for a house. It sounds a little lopsided, right? But the fact is, I truly do believe that, because if you leverage, and I'm not alone in this, this whole, rich dad, poor dad thing, Robert Kiyosaki, all that stuff, good debt, bad debt. If I'm renting property right now, not only am I getting a tax write-off for all the interest that's being paid on that mortgage, but I'm not paying it off. Someone else is paying it off, and then I'm cash flowing on top of it. So essentially, like Warren Buffett and all of these guys that have actually done really well for themselves financially over the years, finding that passive income, making money when you sleep. So that's the problem with home equity, is that it's not liquid. So why does this matter in retirement? Well, most retirees are on a fixed income and they have limited cash flow. We have clients that come to us that just aren't making it every month. So what's the first thing that most people do when they're not making it? Well, they go to their reserves. They go to their life savings. We've had several clients that they're taking money out of their life savings every single month so that they can pay the mortgage. That is a recipe for disaster, because your life savings is really your crown jewel in retirement, because you don't know how long you're going to need it. You could live to 70, you could live to 80, to 90, to 100. Well, the difference between 70 and 100 is 30 years. So you're going to need as much cash as possible, because you just, Boy Scout motto, be prepared. Now, if you're liquidating those funds prematurely to pay off a mortgage, which is basically going mostly to interest anyways, it just doesn't make any sense. So by taking that type of situation, converting a home into a reverse mortgage where the payment is now optional, instead of you taking money out of your life savings to make that monthly mortgage payment, well, now it's going the other way. Now you're actually putting money into savings so that you can prosper and make sure that that nest egg is solvent for the rest of your life, hopefully. And the great thing about that is that you can live in the property that you own. It's your house, and you wouldn't have to, if you chose to. There are monthly payments, but if you choose not to make those monthly payments, you could live in the rest of your house for the rest of your life, or your house for the rest of your life, without ever making another mortgage payment. So this program is just, I've seen it change so many lives. That's why I started these webinars here. So most people, again, they don't want to work into their 60s, into their 70s. They want to work on their art. They want to do things that bring them joy. I mean, that's really, when it boils down to it, that's really what makes most of us sing, is if we find joy in something. So unforeseen medical expenses or car trouble medical expenses are still the number one reason people file for bankruptcy. So to have a safety net in place to counteract that is quite advantageous for a lot of folks. So, the reverse mortgage really does solve this problem of liquidity. I mean, it's not the ideal option is that you would get all of the funds, without having to pay any fees, without having to pay anything for it. You just get access to those funds. But unfortunately, it doesn't work that way. But this is a very, very good option to get access to funds if you need them. So the reverse mortgage is designed to help older adults access equity when they need it. So that glass coffee table full of cash that you can't get to, well, all of a sudden you get a reverse mortgage. Now you got a little drawer. You can take money out when you need it. If you don't need it, you just let it sit in there. But you have the ability to do it now. So basically, it solves it by establishing that line of credit. So you have a line of credit. Basically, if you need funds, you can take from that. Cash payout, again, the guy with the suitcase, cash in the suitcase there. Or you can pay off an existing mortgage. That's really where this loan really sings, because a lot of people are paying these really high mortgage payments, and it's not necessary if you choose this program. Or also converting it to a tenured payment where you're actually getting money back each month. So the reverse mortgage as a financial planning tool, again, this is not talked about nearly enough, especially by financial planners, if you ask me. A lot of financial planners are deemed fiduciaries. Well, a fiduciary is someone who has to make all their decisions in the best light of their client. Well, for most people, their home is their largest asset. For most people. So to ignore someone's largest asset in the whole gestalt view of their financial planning, well, I don't know that's really can call yourself a fiduciary if you're ignoring their largest asset. But the research of Harold Ivinsky, Sean Pfeiffer, John Salter of Texas Tech University, they published an article several years ago about the academic acceptance of the reverse mortgage product as it pertains to the survivability rate of one's assets when using the home equity in a retirement plan. So here's a little chart that kind of goes over that. And as you can see, in almost every single study that they did, if you incorporate home equity into your financial planning, this is if you don't incorporate it. And usually what happens is people will put will basically exhaust their life savings, and then they're left with this house with all the equity in it. They end up selling the house, renting, or moving in with family, and that's fine. But there's a way where that person probably could have stayed in their house for the rest of their life and not ran out of money prematurely. But sometimes, we don't know what we don't know. So there's different types of reverse mortgage loans. The most popular one is a HECM. Well, what the heck is a HECM? So, the term HECM is an acronym for Home Equity Conversion Mortgage. It's FHA's version of the reverse mortgage. It's the loan is administered by HUD, so it does come with certain protections for the homeowner. Those include a non-recourse feature. Well, what does that mean? If you owe $400,000 on the house and it's worth $300,000, they're not going to come after you for that deficiency when either you pass or if you sell the property. If you vacate the residence, you say, to heck with this, go to Costa Rica, you don't have to pay that deficiency back. But if you do pass, they will sell the property to your heirs for 95% of the appraised value. If you owe $400,000, it's worth $300,000, they will sell it to your heirs for $285,000. So $115,000 they're taking a hit on. And you're probably asking yourself, well, why would any bank sign up for that? Well, it's a risk assessment that they're doing. The risk assessment on the reverse mortgage is based on your age and the amount of equity that you have. Risk assessment on a forward mortgage is because, if you borrow money from the bank on a forward mortgage, a regular mortgage, 30-year fixed, first question they got is, how are you going to pay us back? And we're happy to give you this money, but how are you going to pay me back? So they're going to look at your income. They're going to look at your assets. They're going to look at your credit. They're going to look at all of those different types of things that you got going for yourself. And then they're going to pass judgment on you and say, hey, if we lend this money to this person, we're likely to get it back. So basically, sorry, I lost my train of thought there. The other thing that they have is a bank failure security. So if the actual bank that services your loan goes under, big meteor hits the earth and all the banks, go under overnight, of course, we're going to have bigger problems. But just in case that happens, they will take over the servicing of the loan, which is not a bad thing at all. And then also the line of credit will increase accessibility. So you get more access to cash over the years. And all those are growing off current interest rates. So what do you think people with their line of credits, what kind of growth rate do you think they're getting right now? They're getting like 7.5% to 8.5% on these reverse mortgage lines of credit growth. I don't know about you. I'd like to have a savings account or some sort of an account that would grow over time like that. Now, keep in mind, it is a line of credit, but they are getting access to that cash at 7.5% to 8.5% per year. Well, we know who this guy is. This is old Tom Selleck and his legendary mustache here. He was quoted as saying the reverse mortgage loan is just like any other loan. The only difference is how you pay it back. And, old Tom Selleck hit the nail right on the head. So the reverse mortgage, it is just like any other loan. It's still a mortgage. It has a monthly payment, but the payments are optional. If you choose not to make a monthly payment, the balance will grow every single month. Taxes and insurance do need to be paid separately in most cases. So that's something that, you hear when you hear negative things about this program, you hear, oh, they're kicking grandma out on the street. Well, why are they kicking grandma out on the street? Well, she didn't pay her taxes. Well, I've got news for you. If you don't pay your taxes, it doesn't matter if you have a reverse mortgage, a forward mortgage, or no mortgage. If you don't pay your taxes, you can get in trouble. So that's one thing to keep in mind, is that you would not have an escrow account. In some cases, we do set up an escrow account, but it's very rare, and it's credit based in that sense. So the two biggest myths that I come across in this industry, number about the reverse mortgage, is number one, that you'll be upside down in your house in a few years. It's just like saying when the farmer plants his crop, the next day he's going to have his yield. That's the same analogy. They're saying that the farmer's going to go plant his crop tomorrow. We're going to go pick up the harvest. It doesn't work that way. This is a very slow process. So yes, you can go upside down, but it's not going to happen overnight. If you have a 4% appreciation on your home and interest rates around 6%, you'd probably have to live till about 120 to go upside down on a lot of these. So, but can you go upside down? Interest rates may shoot up to 10, 15%. We don't know. If that happens, yeah, there's a good chance you're going to go upside down on the reverse mortgage. Or if we have another 2008 event where all the property values plummet. But I'll tell you what, if we do have another 2008 event, there is no safer loan to be in than a reverse mortgage because of that non-recourse feature. Let's go into more of that next week. So there's three ways to structure the reverse mortgage. You have a line of credit. You can get that line of credit. You can get cash payment or tenured payment. How is the amount determined? Well, it's determined on the age. It's like an actuary table, like a life insurance policy, in the sense that a person who is 62 can borrow less than someone who is 82. Well, if you have any questions for me, once again, my name is Zach Smith. You can always go to chariotreverse.com. I've got my phone number, all my contact information on there. You can schedule time with me. It's a pleasure to be with you today. I hope you all have a very blessed day. And if there's any questions or anything I can do for you in the future, I am at your service. Have a great rest of your day. Thanks a lot.